So, the US Securities and Exchange Commission recently published a statement on disclosure requirements for the crypto industry. What does that mean? How does that affect projects? Joining me today to discuss that is Dr. Chris Brummer. He's a professor of financial technology at Georgetown Law, as well as the founder and CEO of Bluprynt, a company that leverages AI and blockchain technology to automate regulatory and market disclosures for issuers and companies worldwide. Chris, welcome to the podcast. Thanks for joining me.
Hey, thanks so much. I've been looking forward to this.
Yeah, it's been a long time coming. I think I've DM'd you for quite a while now, and I'm glad we were able to finally make it work. I'll just pass it over to a quick word from the sponsor, and then we'll jump into the show. This episode of the Law of Code podcast is brought to you by Day One Law, a boutique corporate law firm founded by recurring guest and friend of the show, Nick Pullman. Nick and his team at Day One Law provide strategic legal counsel to startups, crypto projects, and Web3 innovators. You can get in contact with them via the top link in the show notes below. All right, and we're back just like that. So this podcast, we're going to cover the SEC statement that was titled Offerings and Registrations of Securities in the Crypto Asset Markets. And that addresses their views about certain disclosure requirements, things they have seen, things they want to see more of, including suggestions that impact both American and foreign issuers of crypto asset securities. And to me, this was them saying, here's what we've seen so far from the crypto industry by way of disclosure. That's what we want to see more of, or this is what we want to see more of. And you co-authored an article breaking it all down. You called it a solid foundation for regulatory engagement. I just want to set the stage. So for those who might be more familiar with Georgetown than Bluprynt, tell me a little bit more about what you're doing with the company.
Sure. So you're right. I'm a professor over at Georgetown. I've been teaching securities law for about 18 years. During that period of time, I lived through the process along with lots of different people of really a change in paper-based business to digital businesses to now increasingly blockchain-based businesses. And I noticed that as transactions were changing over time, the way in which many disclosure systems operated were still very much grounded in paper, sending things in cardboard boxes and moving information in very sort of old-fashioned ways. And I noticed that once you get to blockchain-based technologies, you have the opportunity to not just sort of harness information and disclosures, but also to program them and to build on them. And I thought that was such a need and such a fascinating idea. There were more than a couple of iterations and phone calls to the SEC. I testified on sort of disclosures over many years, including sort of before Congress with Libra. And over the years, I just thought that this was something that had to get done, regardless as to whether or not you had some kind of regulatory adaptation. And, I guess I did what a lot of people have done for the last couple hundred years. When you see a problem or a challenge, and if you see others aren't necessarily sort of jumping on it, why not start a company and try to deal with it yourself? And so we've had a lot of great timing, obviously, but also some real support across the ecosystem for people who immediately noticed the fact that our regulatory systems, our compliance systems, even supervisory systems should be keeping up with the way in which business is really done. And if you're going to upgrade business practices, if you're going to upgrade everything from fundraisers to upgrading supply chains, why not try to upgrade, again, the way in which compliance happens and to upgrade the expectations of regulators in a way that is fit for purpose with these new companies. And so I started up Bluprynt, and now I guess 13, 14 months later, we have as clients or folks in our ecosystem, everything from L1s to token launchers to central banks. It's really been a ride. So we're going to keep it going and see where it goes.
And it seems like Bluprynt fits into this middle ground between the regulatory side and the project side. What would you say to projects who are thinking to themselves, okay, why do I need to worry about disclosure because my token's not a security? I'm sure you get those questions all the time.
Yeah, number one, it's really hard to trade something or to expect liquidity for your token if no one trusts or understands that particular financial instrument. And what you're going to see, especially if you're a sustainable project and you really want to build something to last and to grow into something really big, you should be doing certain kinds of things. I mean, what happens and what the expectations are quickly moving into as you sort of make the shift from regulation by enforcement to disclosure, and you even see it in the guidance that the SEC is offering, is this expectation that there's a little bit of a merger between building and disclosure. Like when you build things, you kind of have to tell people about that product that you're building. And if you don't do that, you're not going to have adoption, and it's going to be really hard as an industry to mainstream. Now, importantly, that challenge is a challenge that faces almost all emerging technologies. They're all a little bit complex. Breaking it down is really important. Sharing information is really important, but that can become even more difficult if you don't have a regulatory regime that's adapting with you. So I've testified, I tell regulators all the time that when you think about securities law, basic assumptions as to what core concepts mean has now sort of shifted. This is getting a little bit away from your question, but I think it's helpful just to keep in mind. I mean, what does materiality mean in a blockchain-based ecosystem, or sophistication? I mean, you usually think about sophistication as financial sophistication, your ability to read financial statements, but instead, technical sophistication is probably the better metric for understanding whatever that concept means and whatever relevance it should have. When you think about the fact that key aspects of information is available on a public blockchain, it's available to almost anyone, but the question is, do you have the technical sophistication to be able to access and to understand code, or to be able to sort of peruse a GitHub repository or something? So those are the kinds of very practical things you have to think about. And I think that if you're a builder, you have to understand that ultimately you have to sell something to somebody, and that somebody needs to kind of understand what it is specifically you're selling and what it is specifically that you're building, or else you're not going to be around for too long.
And I think the underlying principle of securities regulation is consumer protection. It's making sure there's no information asymmetry between the projects and the users, whether that is a traditional securities offering or a digital token. That's the underlying emphasis there. And what we've seen over the past few years is almost a straying from that principle, with regulators saying, I'm holding this hammer, your project looks like it could be a nail, I'm going to hit it regardless of the impacts it has to consumers or to users of those underlying assets. Now, the question I have for you is, with this recent SEC disclosure guidance, you've said that this is arguably more impactful or more important than a rule rewrite. Would love to hear you expand on that.
Well, let me just sort of walk back and saying that it's more, and what I write in the little article is that it's certainly more important than what people would think, for a number of reasons. Number one, you are having an engagement with the architecture itself, right? So it's an intellectual exercise where the SEC is actually trying to think through what a tokenized system looks like on its own terms, and then trying to think through what it means for securities law. So you're not putting the cart before the horse. They're actually trying to take a good look at, mix my metaphors here, trying to take a look at the trees and then sort of figure out where they fit in the sort of regulatory forest. And that's a very powerful and very important step that they're taking. By doing this, they're able to draw upon established principles and expectations, while also, again, looking at the particularities of a blockchain-based ecosystem and some of these tokenized systems. So what you're getting is a running start of sorts. And by doing it this way, they're making a number of really interesting moves, right? Like, they are very explicitly starting from the presumption of whether or not you're assuming that you are a security, where exactly does the architecture fit within securities law? And it's also not subtly telling folks that even if you're not falling within the regulatory perimeter, that what they're identifying are things that, as a matter of good hygiene, you should probably be sharing, to your point, on the basis of consumer protection. So that is a writ of authority and a purpose that is actually even broader than just securities law. And I think that's a pretty smart thing to do.
And you gave a few good metaphors there, and I'm sure that's in your bag as a professor. You say the SEC is paying down regulatory debt. I'd love to hear you expand on that.
So when you think about a product build, and there's this concept of tech debt or technology debt, and that is when systems are not revisited, when you are not paying attention to sort of mending your technology and you have your head in the sand, problems can kind of get out of hand. And it takes a lot to clean up technology problems in a build if you're not proactively looking at issues as they arise. And, we've had a lot of regulatory debt building up in the United States. Regulation by enforcement is a very blunt instrument. And without any kind of rule writing, you're not really dealing with the technology and taking the problems on in terms of sort of figuring out market structure, figuring out solutions for participants in a realistic way. And when that happens and you're not doing anything, well, the market and the world and other regulators move on without you. And so now, we're playing a little bit of catch up in the United States because there's been just a lot of regulatory debt now that you have to clean up. Just as if you were sprinting with the build and you're ignoring some of your problems, and then you realize after your build that there's a bunch of tech debt that's built up. I think that the principle is ultimately applicable to supervisors and policymakers as well. And so, from the outside looking in, and you're saying, okay, what's going on here? Why is the SEC having these basic roundtables to get to their solutions and the industry engagement or what have you? It's in large part a reflection of the fact that it wasn't done over the last couple of years. And so you have to accelerate key foundational steps because there's just a lot of administrative work that has to get done. And there's a lot of messy things that you kind of have to clean up in order to come out with a workable regulatory solution.
And I think that's why your point about the issuance of this type of guidance is arguably more important than a rule rewrite is a good one, right? Because we're starting to see you don't get rewritten rules without these initial first steps and the changing of the headwinds. And that's what this is.
Yeah, and obviously you do have other, things going on in town in Washington, D.C., across the street, over on Capitol Hill, and they're going to have something to say as well. But it is also making an important point, which is there are principles in securities law that are relevant. They just have to be kind of updated and revisited and modernized to the technology that's before you. But it's not a question of just sort of throwing everything out and saying, you don't, securities law is in, there's no applicability, there's nothing good in it. It's more or less saying, okay, we need to dust things off and take a fresh look at the technology and then figuring out, again, what do those principles in securities law mean for tokenized systems that fall within the SEC's ambit of authority? And again, even if they're not, what are some good practices that one can recognize in securities law and in our expectations of disclosure? And I think that's extraordinarily helpful and super logical. I myself, for whatever it's worth, bugging the CorpFin department for years to do something like this. So I was just delighted to see some steps taken last week.
And I think it also bodes well for the rest of the world when the US steps up and takes some leadership here. And it's been lagging over the past few years just to show what guidance could look like for the rest of the world.
It absolutely, there are international organizations like IOSCO. There are other regulators around the world. And, when the SEC steps up to provide that kind of guidance, it helps to direct and in some instances inspire regulatory rulemaking and analysis in other jurisdictions. I mean, that's something we've seen over at Bluprynt. We've seen firsthand that, when the United States engages in the space and other regulators get a cue that it's time for them to do so as well.
And when they take the opposite approach, IOSCO and other groups like that tend to follow suit as well too.
Yeah, it's very hard. I mean, the United States is a major participant in IOSCO and many other standard setting organizations. So, if they're disengaged or not enthusiastic about certain policy streams, then that tends to be reflected at the global level as well.
And that has effects downstream as well, right? You see
Correct.
Regulators in Canada, regulators in Europe, all over the place following those IOSCO guidance, et cetera. For those who might not be familiar with IOSCO, could you just quickly explain what that group is?
Yeah, it's like the if you know Star Wars, it's like the Galactic Senate of securities regulators. So it's an international standard setting body where all of the securities regulators sends a representative, almost like a United Nations of securities regulators, and they come out with best practices. And those best practices do not have the force of formal public international law, but they are commitments nonetheless being made by the regulatory agencies, and they take those commitments, those guidelines, those best practices, and it's the responsibility of each of those regulators to go back home and through their domestic administrative law processes to promulgate rules that are consonant with those international best practices. So to your point, if there's nothing being done at the international level, you can still do it domestically, but likely in the absence of a kind of robust coordination. And, again, it's a little bit of a chicken and egg problem, like, do you need the domestic rule or do you need the international rule? And sometimes one will come before the other. But where you have the United States offering guidance like this, it dramatically accelerates what can happen at the international level and the cues that other regulators are taking.
Especially when it comes to crypto, where it's so difficult to put that regulatory moat between jurisdictions.
That's right. It's inherently global asset. It's on the internet. So, it's something that innately crosses borders. So it's profoundly useful to provide guidance in this way.
And one of the examples of guidance that they included was having smart contracts as exhibits and analogizing them to legal agreements, giving them sort of that status where they're worth including. And to me, this was such a good example of regulators catching up to the times and catching up to what the reality of the situation is, couched in consumer protection, right? If you have a project that has a smart contract that all these users are relying on, the users should be able to see that publicly, and you should stand by it and have something on the line to say this is actually what we're putting out there.
It's really kind of very interesting because the SEC is looking at smart contracts for sure. There are still outstanding questions about, okay, once you identify the smart contract, because things are on chain, there are lots of interesting applications, even from a regulatory standpoint, that the SEC could be later considering from its own regulatory or supervisory toolbox. But in any event, you're thinking about audits and smart contracts. You're thinking about the underlying network and how it's supposed to operate, and trying to sort of suss out what's important and what's not. If you're thinking about governance, what's that governance supposed to look like? And all of those things aren't normally or traditionally addressed by traditional securities law, right? And because in the United States, you have something called, S1, sort of your initial document, and here the SEC references a number of different documents. I think the Form 1A, basically depending on how large of an offering a securities offering is going to be and what kinds of investors are actually going to be purchasing securities, that those documents have certain standard mandated disclosures, but none of those mandated disclosures tackle the particularities of on-chain finance, right? So there is no mandated line in the documentation that says, explain your tokenomics here, or, your smart contract is to be placed there. So they're again looking at, well, what's relevant and what's important, and then trying to map that to securities law. Now, just sort of taking a step back on a more bigger level, right? What are the limitations for what they're doing is not a bad question to ask. The guidance is being provided very specifically in the context of securities law. So it doesn't necessarily get headfirst into the question of when does securities law apply. It's just sort of saying, well, when it does apply, here are things you should be thinking about. And by the way, even if it doesn't apply, these are some pretty good things to think about regardless. So there's still this outstanding legal question that's floating around. And as I said, Congress may be the folks to tackle that head on. But you have this thing called an investment contract. I know you're in Canada, so you guys, I think, are pretty familiar as well with the Howey test and how an investment contract is sort of defined. But you have this thing called an investment contract, and so there's this lingering question of what are the expectations of disclosure for the asset referenced in an investment contract. So when you think about all the different prongs, you have this thing called an investment contract where you could have a crypto asset, but the crypto asset itself may not necessarily be a security, but it may be embedded in an overall scheme where you have all the different prongs of Howey being triggered. It does sort of raise very interesting questions that, okay, so even if you have a larger investment contract, that would trigger disclosure obligations. Those disclosure obligations would most certainly require some kind of information being proffered about the underlying crypto asset which is sort of the basis of the investment contract. But once the fundraise is done, what does that mean for ongoing disclosure obligations vis-a-vis the underlying crypto asset? Right. And that's a really super interesting question that this kind of guidance isn't designed to get into. But again, I think that and by the way, that under securities law, that's a sort of wide open question. And one of the advantages of sort of operating in the way in which the SEC is here with this particular approach is it's saying, well, even if there may not be a bright line as to when securities law applies or not, you're going to have to anyway, assuming that, you're falling under Howey. And this is really good stuff to apply anyway. So if you want to sort of stay safe, you should probably just continue to consider this an ongoing disclosure requirement. But don't look at this as something that's just totally horrible, because it's probably going to be pretty good for your business anyway if you're a legitimate business, for people to be able to differentiate from others and to understand exactly what the value proposition is for your product. And I think that's one way to kind of think about like the untold, unsaid assumptions or the policy direction that's kind of lurking in the background, even as the SEC is providing this very much sought after guidance.
And I think the one question that I've heard a lot from projects when it comes to guidance around disclosure from a securities perspective is, okay, does this apply to us? Is this relevant? Can I just ignore it? How do you think projects should think about guidance in this particular circumstance?
So let me just say, like I'm going to tell you what I think tokens should think, and I also want to put a little plug for what I think regulators should think as well. I think that if you're a token issuer and if you have a good project and a good idea, transparency is your friend. I do think that there is a possibility that you have, as the space grows, as the interest continues to grow, as the regulatory hurdles are reduced, you're going to have much more activity in crypto assets. Some of it's going to be good and some of it's going to be bad. And reputationally, and as a matter of trust, good actors are going to, and by the way, I'll put on my professor hat here, there's literally over a quarter century worth of data, even relating to something called the bonding hypothesis, basically saying that when an issuer decides to not only issue a stock in their home jurisdiction, but to also voluntarily issue shares in the United States, it tends to positively impact the value of that share because the investor knows that the issuer has sort of subjected themselves or bonded themselves to a high quality regulatory regime. That sort of same basic logic kind of applies, that if you're a solid actor and you can de-risk yourself by providing certain kinds of disclosures, it's going to be much easier for you to find liquidity, investors, to be viewed as a leader. And to the extent to which the space is inhabited over time by people taking advantage of the lower regulatory hurdles, that kind of product differentiation is going to be more and more important. Now, at the same time, even as that becomes more important, and I think, by the way, you see that not just with regulated assets, I can tell you from the kind of calls that we get and the conversations that we have, that's also something that happens in DeFi. And even though DeFi is not immediately being regulated, people understand the value of solid reputations and trust. And even as a matter, for Bluprynt, I just found it, even when we first launched our products, it was very fascinating because the people who are most coming to us, everyone has certain kinds of assumptions as who would be coming to us first, and it's contrary to what anyone would think. We were first hearing from DeFi and central banks, right? Which is one heck of a combination, right? But it's people who do understand that whether or not you're directly regulated or not, this is kind of relevant to your business, right? Now, for the regulators, I think it's really super important to be able to get your mind around the fact that you need to enable people to comply, right? And if you have new technologies, you need to make it as easy as possible for people to opt in and do the right thing. And that means obviously providing the guidance and creating the tools and crypto native approaches to onboard, new participants in this technology. And I think this is a first step. I think we're going to see a lot more. I think we're going to see, frankly, much more than anyone is predicting when it comes to innovation in terms of disclosure and compliance and the rules and rethinking kind of core concepts when you're not working from pieces of paper, but instead operating from pieces of code. And it's going to be quite a ride in the next 24 months. I don't think this is like a 5-year, 10-year thing. I think this is more like a 2-year thing. And so there's going to be a lot of really interesting work to be done. But yeah, with all that being said, if I'm a token issuer, I would jump on the disclosure bus real soon, because it's good. It's going to be good for your business. The regulators are heading in that direction. They're pivoting from regulation by enforcement to disclosure. And I think that, regulatorily, there are going to be some pretty substantive and technical changes as well, from the regulators.
All right. Thanks, everyone, for listening. That's another episode of the Law of Code podcast in the bank. If you're interested in learning more about our sponsor, Day One Law, you can find a link in the show notes below. We'll see you next time.